Assalamu alaikum. I've also been making the feasibilities for National University of Science and Technology NUST and maintaining the cash budget, cash flow, uh, so that we are uh, well aware of upcoming cash needs and the cash revenues and can properly manage the surplus or the deficits, and so that there is no embarrassment at the 11th hour. So that is the crux of financial management, the cash flow, maintaining the projected cash flow, and to be well aware of uh, anticipated cash conditions. And further, as I have already told you, that I have been maintaining um, I have been making the cash, sorry, feasibilities of different projects like NUST Science and Technology Park, STP, NUST Solar Park, the Solar Energy Project, and NUST Teaching Hospital Project. I've been making their feasibilities and sensitivity analysis as well. And there are other feasibilities also which they have been contemplating from time to time, trivially, tentatively. Some were successful, some were not successful, but I've been involved on uh, all those tasks. So that is the relevant and important function of a business that finance can handle, and we often ignore these aspects. We just maintain the financial accounts and prepare the financial statements at the year end for the need of tax department or for the need of corporate department or for the need of donors, trustees, or government organizations. So that is not the total exploitation of financial knowledge. Let's see the cash budget now. Uh, this is the monthly cash budget. Um, Here, it's the revenue side, the receipts, the grants which we take from the government, and their expected timing of cash flows during the year. And then this is the HEC grant. These are the tuition fees which are receivable from the students, and we also give some financial assistance out of this tuition fee, which have been subtracted from it. And there is the hostel fee, um, which we receive from the borders, and there are admission fees as well, and student securities which are received at the time of admission, and the rents. Uh, we have also apartments for the teachers and faculty and the staff. So rent is also one of our source of revenue. We give them their full salaries, and we subtract the rents and account it separately. And investment income. This is another major source of income uh, which has been introduced by me, uh, in which we can even uh, invest the very short-term surpluses as well and make an extra source of revenue. At that time, it was at 11.75%. Then there is the mass surplus, and then there are payments. These are all the recurring or operational budget items. And I shall also include the capital budget items as well in this. So the operational payments include the payroll, main operational payment, and accommodation, hiring. Uh, this is the payment along with salary to some of the staff, which is called the hiring payment, which is against their house rents, which they have to pay to their landlords. We reimburse those house rent, and that is called the hiring. And then the electricity, gas, phone, internet bills, fuels, fuel for vehicles, fuel for generators, and vehicle maintenance, consumer stores. All the expenses are being tried best to be included in here. And also, it has been tried that it should be kept as simple as possible so that the senior management may not get much confused in petty figures. And likewise, there is a capital budget um, for the capital projects we receive from the government grants. And this is a HEC development budget, which we were expecting to receive in that period. And the installments were being expected to be received in these months. And this is the Ministry of Science and Technology most source of capital budget. And these are the payments out of the capital budgets: construction payments and minor repairs and computer installations, etc. And it doesn't include simply the computers or desktops or laptops. It includes the whole infrastructure of the computer, like laying the cables and installation of servers, um, everything of not only the uh, computers but also the infrastructure. Then there are other projects like furniture for the auditorium, furniture for the gym, hostel, and security equipment, sports equipment, and expected new purchase of vehicles. And there is some contingency budget has also been. Uh, it's You can say it's a cushion or margin for any excess demand from the anticipated demand. So that gives the total payments and then the net cash flow of the capital, and this is the total net cash flow. And then the previous balance is brought forward and adjusted, and then we get the uh, cash flow. Uh, and we can, if in any month there is a deficit in the cash flow, we substantiate it from encashment of the investments. And when there is too much surplus, we invest it in the short term uh, investments. And hence, this is the final cash flow. And this is the uh, investments, marketable investments, which can also be considered equivalent to the cash. So this is also being added into the uh, cash in bank. So this is the total figure. And these figures and calculations are based on these data, the bank balances in dollars and Pak rupees in all the accounts. Uh, these accounts have been separately maintained for the development grants for the trust like pension trust, GP fund trust, CP fund trust, and recurring grants or recurring revenues. All these accounts are separately maintained and their balances are taken and these are adjusted. Some of the accounts are over in the um, um, countries abroad like Australia, USA, UK, and some dollar accounts are also in the local banks. So that is how this is the fee revenue, tuition fee, entry test fee, admission fee, hostel fee. This is entry test fee when the admissions uh, are being conducted. At that time, we collect the admission fees, and these are the tuition fee at the start of every semester, and these are the uh, hostel fees collected along with the tuition fees, and this is the total revenue. And these are the assumptions on which this is based. All the collection is like new batch will be added of 4,000 students, and new borders will be added. Total borders will be this much, and total students will be this much, and so on. And average fee per month, admission fee, entry fees, all these uh, basic parameters uh, are mathematically processed, and they result into these total figures. So this is the fee budget which is included in the main cash flow in summarized figures. This is the ICT or computer budget. ICT expenditures like equipment for the classrooms like projectors or other items for teaching, hardware, local area network maintenance, SLAs, agreements, payment, ICT software, all these payments. So this is the ICT budget. This is main summary of the fee, and these are the operational expenses, hostels, securities, horticulture, and like administration, stores, and this is because this expense was given in for the full year, but we have to allocate them over the month. So I calculated the trend of expenses from these figures, that how much uh, expenses are made in every month. So on this trend, these expenses were projected and distributed over the months. So that is how the monthly cash flow projections were being maintained. This is very uh, essential uh, tool for the managing the organization, and keep an eye on the surplus or deficit cash whenever it is expected, so that we are prepared in advance. Now let me show you one of the feasibility. Now this is a feasibility of solarization. Uh, these are the results of the parameters. Uh, there were three scenarios, like should we construct the solar plant through a PPP mode, build, operate, and transfer. Like in which mode a private investor invests totally into the project, and then he recovers his money with some profit, by some mode like selling its output, uh, and after the already agreed predetermined period of BOT, which is called concession period, he delivers the project totally, handovers it to the government institution with which he had agreed the agreement of construction or investment. So this is the build, operate, and transfer mode. Uh, Here is the electricity price. And there are three um, levels of sensitivity: most likely, optimistic, and pessimistic. And these were the uh, main factors, like what will be the price, main sensitive factors, and whether the price will be kept floating or fixed. Floating means that he will keep changing prices as the price of the WAPDA changes. So if the WAPDA unit is say 15 rupees, and he has agreed that I shall keep a difference of 1 rupee, then he will charge us 14 rupees. And when the WAPDA rate gets 16 rupees, he will charge us 15 rupees. So he will keep changing, keeping the difference constant, but the price will be changing with the price of the benchmark with which he will compare. So that is called the floating mode, and the fixed mode, and the floating mode. So BOT tenor, which is a concession period, whether he will hand over the project in 15 years, 10 years, or 15 years, and whether he will take the loan or not. So these are the assumptions, and this is the NUST perspective of the factors of financial feasibility, the results of financial feasibilities, which are IRR, NPV, and payback. For the convenience of understanding by the senior officers, they asked me to put the terminology of saving instead of NPV. So here I have used the saving as NPV. Saving discounted at 12%. So that will give this much to the NUST. And this is total saving of electricity from the WAMDA, and the electricity which will be sold by the BOT investor to us for the 15 years. And this is the saving over the life of the project, and this is the saving of the BOT period. So that is why this is less than this. And since NUST doesn't have investment in this mode of BOT, so there is no question of NUST IRR. That is why it is giving NA over here, and there is no question of payback even. So only NUST will consider its saving. This is the NUST perspective. Now this is the investor's perspective. And this is the investor's NPV, and investor's IRR, and investor payback. So we have to show in the feasibility analysis, sensitivity analysis, we have to show to the investor also that they how much they will get from this project, because we want to agree on a win-win solution, and we have to give regard to the investor's perspective as well. And this is the overall project's return: NPV, IRR, and payback. These are the final three uh, aspects or perspectives which are considered in deciding should we embark on the project or not. And then there is the second scenario of NUST wholly investment, EPC. EPC means installation, procure, and commission. So in this also there are three levels of sensitivity. And here sensitive, the most sensitive factor is the capital cost, which is in most likely case 120 million, 110 million, and 130 million. And then there is also the loan. Should we take the loan or should not from the State Bank? Because State Bank had the scheme at that time of investing in the renewable energy projects. And then for these, headings are the same, all row headings. So I haven't repeated it over here. So these will hold same for these columns also. This is the NPV discounted. This is the simple NPV uh, discounted as well as for the whole period of the project. And this is the NPV for the BOT period. And but this doesn't concern in over here because there is no BOT period. But the formula was copied over here too, so that is why it is showing here. And then there is IRR, internal rate of return, and payback. These are the NUST perspective. And since there is no investor over here, so investor's perspective is not being calculated here. There is N. Then total project perspective, and this is how the now the third is NUST should lease it from some leasing company. And there the significant factors are markup rate, leasing tenor, and down payment. So SBP loan, since it is being leased, so there is no question of SBP loan, so it is zero. So saving, that is NPV, we will get over the total life of the project. Then NPV in the BOT. Again, here the BOT will be the lease period, 10 years, 10 years and 15 years. So IRR, then we get the payback period. Since there is only 10% down payment our investment, so payback period is also very short, 2 years. And the investor's perspective, investor is the leasing company, and they're saving in rupees million, and uh, their IRR. Their IRR is same as their leasing rate, and their payback at 18% they will recover in 4 years their original investment. And then there are the projects returns. These final results are based on these parameters whose these parameters whose which can be varied over here, and their results can be checked in the final results. And the rationale of each parameter has been given. Uh, what was the source and rationale of each parameter? Like there will be 1% degradation in the electricity production capacity of the solar panels. So this was agreed with the consensus of the meetings, and it was also carried from the uh, marketing staff of the solar panel. And the project was being installed for the zero point 0.5 megawatt so that we reap the benefit of economy of scale. And the installation cost is 110 million. This was for the full 1 megawatt project, but for the half megawatt, this will be halved in the calculation. So its price was obtained by discussion with the parties which were interested in selling their equipment. And the rate of electricity which we are paying currently at that time, and what will be the rate floating or fixed agreed with the BOT party, and what will be the staff we will be hiring for this project, and what will be their salaries, what will be the insurance cost, what will be the depreciation for tax purposes, what will be the debt equity ratio, and likewise there are many factors, project life, I don't want to take much of your time, and I have also determined the sensitivity of each factor. Negative means if the factor is increased, there will be decrease in the NPV, IRR, the profitability factors of the project. So the return will decrease. So this has the negative effect. Degradation. More there is degradation, there will be more loss. And also the installation cost, higher the installation cost, so there will be a loss in the um, feasibility factors also, like NPV, IRR, payback, you know, and likewise other factors, and what is their rate of sensitivity, how important, how crucial are these factors. This percentage will tell you the sensitive percentage. Debt equity, what will you keep the debt equity ratio? So it is positive because higher the debt and your contribution is lesser. The because a loan was this SBP subsidized loan at a very low rate, so you will be at advantage. So this is a positive factor. An annual increase in electricity rate. If the electricity rate increases, then you will be at advantage because you have a fixed cost at the beginning and there is no major operational cost of this project. And the production, higher the production of your plant, the better it is. So it is positive. It has positive sensitivity. So here the graph of demand versus production is also given. This is based on very detailed study. Hourly demand of the electricity was taken, and that was accumulated monthly, and then the graph was made. This blue indicates the demand and the red indicates the production. Production is almost constant over the year. There may be some decline, slight decline, or slight rise in the winters and summers depending on the season and sunlight exposure. And the demand also increases or decreases. That depends on the students' vacations and the seasons of air conditioning, etc. So this was also checked whether we are fulfilling the demand, and we or not. We may not have installed extra capacity which may go waste. And then cash flow was made. detailed cash flow over the 40 years. Although the project may not uh, sustain for these much years because solar panels have limited life, but for the on the demand of my management, I extended it to that much time period. And there the uh, cost, operational cost, and installation cost is given. Then the electricity price, which we will be saving by installation of this project. So that is our revenue, and this become the cumulative cash flow. This is the SBP loan. If we consider the borrowing, then this is the loan cash flow, and these are the units which will this plant will be producing, and these are some of the units which we may lo- lose, like in some months or in some years. Uh, we may have a slightly extra production uh, as compared to the total units produced, um, that may go waste in the daytime. So that will give us the net cash flow. In this is all in millions rupees in million, and this cash flow is uh, further allocated to what will be the investors' cash flow, what will the NUST's cash flow, and what will be the markup principle. This is the uh, table for the loan and lease payments, the cash flow of the loan and cash flow of the lease, which has been whose net amount will be uh, used over here for to determine the net cash flow. So that is how the this is the working of uh, the electricity price which we will be saving by installation of this project. We took the monthly bill and determined the units consumed, and then we determined the average price of electricity. And we also collected rates from the uh, ISCO Islamabad Electrical Supply Company website, and these are peak and off-peak rates. The off-peak rates will be applicable to our project because off-peak means the daytime. Uh, so the solar plant will be producing in the daytime only because we were not intending to install the batteries to store the electricity. So we, for all our working, we took the off-peak rate, and this source has also been given for anyone to confirm the workings. And this is the source from the Wabda official who also had. We also sought help from him, and his phone number and name is also given if anyone want to confirm. And so this all information was given for the uh, assurance of the management. And these are some of the assumptions which have been given. If you want to consider the net metering, then the conditions of net metering is given here. And this is the table of monthly demand of electricity in megawatts, And this is a daily demand, and from the daily demand and monthly, this is the production of the solar plant. So over the 24 hours, you know, at like in from April to September, the sun rises even at 6 o'clock. So from the 6 onwards, the electricity is being produced. So this is the production uh, projection, and this is the demand. This is also the production expanded uh, by the days every day, and this is how the difference of spoilage has been calculated. How much will go unutilized. This was the production trend only, and the spoilage was calculated from production minus the demand. This is the demand of every hour and on daily basis. And this is the spoilage every hour. This is some of the spoilage because at 12 o'clock and 1 o'clock, the panels may be producing the highest output. So some of the units may go spoiled because in the transient weather of October, when there is not so hot and not even so um, cold, the electricity demand decreases, and in the daytime, the electricity production is highest, so some of the output may go waste. So this is how, by taking the difference, we determined how much may spoil. But this was very nominal, so it didn't affect much on the uh, feasibility. This is how I explained the different scenarios. Like there are three scenarios: PPA, EPC, and lease. And within these three scenarios, there are three sensitivity levels. And these are some of the documents whose links have been given here, which determine the feasibility, affect the feasibility. Some legal determine some legal requirements uh, of ISO, WAPDA, and the legal requirements of State Bank. You know, so I included everything for the satisfaction of management that I did not prepare this feasibility um, in uh, you know I have prepared the feasibility in authentic way and haven't prepared it in a haphazard way or without any rational basis. I prepared everything with uh, proper resources, authentic resources. And these are some of the tables for the convenience of understanding of the management, like uh, what how the loan will affect our return, because management was considering that when we get the loan, the the our return should be lesser because we have to make the payments of the loan also. But I tried to convince them, then if the return of the project is higher than the interest rate, then your return will get higher if you um, if you share your investment burden with the bank, and they cost you lesser than the profit return of the project. And this is the leasing table. This was made for the satisfaction of leasing company, that will the Nust available able to pay the lease installments, and will it get enough returns from this project. So that is how I make the feasibilities. This is one of the examples. And likewise, I have been preparing the feasibilities of teaching hospital and the feasibility of a science and technology park. And there were also some feasibilities which I don't recall right now, but I've been involved in managerial tasks also. I hope you like it. So thank you very much.